I just remember thinking like, well, that was the easiest money I've ever made in my life. I have people all the time ask me, "Oh, you day trade?"
Yeah.
I'm like, well, not in the sense that you probably think about it, because like,
Yeah.
well, yeah, like this year I'm up over 100%. Nobody comes into the market and says I'm going to be a trader and thinks to themselves, I'm going to take small little wins over time. Everybody coming into the game thinks I'm going to
Oh,
make good money. Everyone in their trading career is going to reach that point where they want to quit, where they don't think they have what it takes, where they think they've been beaten, and it is inevitable you will arrive at that point at some point, and that's the make it or break it between who's actually going to be a trader and who's going to go home and sit on their couch.
today, I had the honor of talking to New Trader. He's probably one of the most unique traders I've ever gotten to know. We've been friends for a while now. He is a moderator in the Discord. So if you're in the Discord, you've seen his username before, but you likely have never heard him talk in person or even talk about what he does, the detail that we're going to cover in this podcast. It gets pretty juicy. And he comes from a very unique background. He's self-taught, vet, who's now married, has kids, is an Uber driver. He's been doing most of his trading out of his car, but lately has been pivoting to full-time trading. He's the definition of slowly getting rich. And that's from the sell side of options, which is a lot different than most of the traders in the Discord and for most traders in general who don't have a lot of experience when it comes to selling options. So consider this almost a masterclass and a view of how you do this successfully. And with that, I hope you enjoy the podcast. I love the irony of your name too, by the way. But I want to actually, because I don't even think I know this. How did you initially get into trading, and when you started? What was the goal, and what was that like? What was your path?
Well, I was working for a financial institution at the time, and they had some stock options that were some of the benefits that they offered, and I was taking advantage of that, just buying company stock, and it was something that I really like. I've always put money aside and invested like longer term, 401ks and different funds like that. But this was really the first stock that I had actually like any significant amount of money directly into a stock. And it really wasn't doing a whole lot. I mean, it's a financial institution. They're not really highly volatile companies. I didn't even know what volatility was at the time. Um, and so I just basically set what I thought was kind of a ridiculous amount for a limit sell and never looked at it again. Um, and it really wasn't even that long that maybe a couple months later that I just got a notification on my phone that said a trade had been executed. And I looked and I was like, oh, snap, because it wasn't even close to the price at the time that I put the limit order in. And I just remember thinking, like, well, that was the easiest money I've ever made in my life. Like, and it was, a substantial amount of money. And I was like, maybe there's something to this. So I started just looking online, trying to find a little bit more information about actually trading, like actively trading. And I found a podcast. The guy's name is, I believe it's Tyrone Jackson or something like that, and he does some kind of, it's a little gimmicky. He's got like this basically podcast where he talks about wealth creation through covered call writing. That's his number one strategy that he introduces and is the fundamental basis of the podcast is just covered call writing in mainly Dow and S&P 500, top top tier type stocks. So I was traveling on like a 16-hour car trip. So I binge listened for like 10, 12 hours straight to this guy talking about this. And the way he was talking about it, of course he's selling himself as well. So he's super positive, gets your attention, and makes it sound incredibly easy. So I thought to myself, well, shoot, it sounds like it's a like you can't lose. It's like a win-win. So I'm gonna try this out. So I took that money that I had from selling that stock, along with I might have added a little bit more money to it, but I had, it wasn't a ton of money. I think maybe I want to say maybe like 15 grand. So it wasn't a ton of money,
It's a
but
good starting
I
point,
took
though.
that money and figured, yeah, I mean, it
Yeah.
was something to start with. Um, and it was something that I didn't need the money for anything else. So it was just sitting there. I didn't have anything that I needed to buy with it. So I put that into, I opened a TD Ameritrade account and I put that in there. And I immediately started screwing up and doing all the wrong things right away. Um, even according to his advice in his podcast that I was listening to, I still didn't follow him because what do you do when you're just starting out? You look for cheap stocks, right?
Right.
You look for stocks that you can get the most bang for your buck. When you're selling covered calls, you need 100 shares of a stock in order to be able to write a call against it. Brokerages won't let you sell naked calls against stock when you initially open an account because you don't have any experience. So what do? I think I took probably 60 to 70% right off the bat and bought Ford stock. And this was back when Ford stock was, I think it was around $10 a share. But just straight up for the next, I don't know how many months, Ford did nothing but go down, 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 slowly and steadily. Some days it would be down, a couple cents on the day, and then other days it would be down like 50 cents, which it doesn't sound like a lot, but when you've got, I
On
don't
your ten
remember how
dollar
many
stock.
thousand shares it was at the time.
Yeah.
Yeah, and and I also used, I don't remember if I used margin or not, but I remember my position size was just way too freaking big, and I just wrote at the money calls against it, and that was nice collecting that premium. But premium only gets you so far you're if you're swimming upstream. If you have like a covered call strategy is a bullish strategy, you need the stock to at a minimum not go down more than the premium that you collect in order to make money. Um, and I don't think it was years before Ford even recovered. I mean, it went down through the pandemic. It was down at like $4 a share, and it wasn't until post-pandemic that Ford's back up above $10. So had I stayed in that trade, which I did stay in it way, way too long, um, but had I stayed in that trade, it would have been, I don't remember how many years until I would have even broke even on that strategy, even with writing calls. Um, and but that got me interested and it got me active. So and it made me also realize how much I didn't know. Like going out there, he made it sound so easy. And I truly did believe that you could be successful doing it. But I obviously didn't know enough about the market and I wasn't educated enough to make it work. So I started looking for more information and like trying to figure this thing out. And that probably took a period of a year and a half to 2 solid years of just consuming content. Like, and I'm not talking about consuming content like, you know, a couple of hours a week or even a couple of hours a day. I would consume market content um, for up to 10 hours a day for, you know, probably 5 to 6 days a week um, for 2 years. I
Yeah.
just completely engrossed myself in it. And
Are you
what I
trading
do
this
for
whole
work,
time too?
uh, yes,
Yeah.
yes, not very successfully, but I am trading. So I'm learning. So I'm learning about things like spreads. And when you have a small account, you're limited to things like spreads. So every
Right.
new trader is going to start off, and I guess we should probably cover some of the fun. We can backtrack and cover some of like because a lot of people that watch this are really not going to know some of the terminology that I'm talking about. Some of
No.
the
Yeah. I want to hear about your
some
story and
of
then we'll get into that. And even talk about
yeah.
the market and everything.
So
Yeah.
then I learned more about spreads. So you start off with cover call. Well, even before I learned about spreads, I do what every other new trader out there does, and that's what they buy
Penny
premium,
stocks.
they buy
Oh.
options. Yeah, no, no, no. Hopefully you buy good stocks, but no,
Yeah.
I told myself, there's there's this glamorous unlimited profitability to buying premium. You buy an option, and there's a theoretically unlimited amount that it can go up. So I would play around with that, but I didn't have the patience to give myself enough time. I didn't understand theta decay in a way that even with buying premium, which now I rarely buy premium, I only sell it. So even with buying contracts, I would get directional moves and I would be up a little bit, and every once in a while I'm making money here or there, but it seemed like a zero sum game. And and the longer that I watched, and the content that I consumed was mostly, probably 90% of it was the Tasty network,
Sports.
Tasty Live Network, which is the founder of which is Tom Sosnos, the guy that wrote the software for TD Ameritrade, sold it to TD Ameritrade, Thinkorswim. His team created that software and sold it to them, and then they went out and started a new company. And the new company is basically a brokerage firm with a marketing arm that is a financial media company. So instead of like advertising and all that kind of stuff, they said, we're going to try to make a Howard Stern of finance type uh, radio slash TV show. And that'll be our marketing arm. It'll bring people in. And it worked for me because when I started to, even on YouTube, search for more information about different strategies and just statistics and studies and all that kind of stuff, I kept coming back to these same videos that were all these market measures that Tasty Trade, at the time it was called Tasty Trade, in a rebranded sense, had put out. And their content just blew. They made it so easy to understand, and they presented the data in a way where I could get behind and have confidence behind why I was doing what I was doing. And they even taught me what to look for when entering into a trade, what's a smart trade, and understanding the probabilities of being successful, and understanding that, for me anyway, I'm not that good. I'm not a technician. I don't look at the charts and think, okay, this is bullish. Like, I understand the basics. I understand support, resistance, and I understand a little bit, but I'm not a fundamentals guy either. So if you're not a fundamentals if you're not a fundamentals guy and you're not a technician, what are you left with? The only thing that you're left with is quantitative or probabilistic approach. And me being not that good, I found it very appealing that I could choose my probability of success and give myself time to be correct and give myself space in the market so I can sell that premium away from the stock and just allow the stock to either beat me or not.
Yeah.
And that's basically how I got into it. And then the coolest part of it in my mind was, you start making a little bit of money, but the mindset shift that happened to me, I started finding myself, okay, at the end of the week, I've got, X amount that I have set aside for bills. I've got X amount. I started finding money that I wanted to put in the market. Like, I started realizing the value of this thing. And all of a sudden, it wasn't like I got a raise. It wasn't like anything changed in my financial situation. However, I found myself committing more and more capital to my account and to the market and to just even saving in long-term investing as well, simply because I was interested in it, and it became a priority to me, and I understood the value of participating in the market. Now, being successful is incredibly marginal. There's a very little difference between a successful trader and a unsuccessful trader. I really think that success is just it's you can
It
understand all
depends.
these concepts and still not be successful for a long period of time. So it's just that there's a very marginal difference between being successful and not being successful. And
It's
the
execution.
key to being successful, well, it's longevity.
Oh,
And
okay.
the only
That's a
way
good
that you
one.
can maintain longevity in a market where you're participating is by staying alive long enough to learn the lessons that you need to learn and participating in it. You have to be able to continually
Mhm.
participate with solid strategies over time, let them work out. And the only way that you can do that is by keeping your position sizes small relative to whatever your portfolio size is. Um, so fortunately, now there were a couple of times where I almost completely blew up. Like, I got, especially during COVID crash. That was the first time I've experienced anything like that. GameStop was another one that almost took me out. I was on the wrong side of GameStop. I was short that from like $20 a share. That was brutal. So there was a couple of times where, like, yeah, I tried to stay small, but you really don't understand how big small is until you go into an outlier event where you have a black swan type event where you've got multi standard deviation moves that are going against you. And that's all fine and dandy if you're small enough and you know how to manage the risk. But at the time, I I didn't have the experience to know how to manage the risk in the best way. So there were a couple times where I was like, all right, this is it. Like I'm either going to get destroyed here or because I was too large. Even though I started off small, things in the market, especially when you're on the short side of premium, if you don't manage your positions and you don't know what to do when things go against you, it can escalate very quickly.
Yeah.
And it did a few times. But again, longevity, staying small, it didn't take me out of the game. And even though I was down oh, with the whole COVID thing, man, it was ugly. I had just gotten into trading futures as well, and I did not understand the risk of futures as well as I should have. They're extremely leveraged, and instead of just cutting my losses when obviously things were not working well, what did I do? I doubled down and I did all kinds of stupid stuff. I lost a lot of money, but I didn't give up. And what's the beautiful thing about when you go through something like COVID? Well, what happens after COVID? What happens after this last
uh,
cycle that we just saw of a drawdown? You have money printing ability. If you, as long as you
yeah.
realize that, okay, I'm not going to quit. I'm going to stick with it. I'm going to stay long. Some of these really dirt cheap stocks that then you basically are printing money for. In the case of COVID, it was the next year and a half. There was nothing you could do
Nonstop.
that was wrong. Yeah,
Yeah.
so you make all that money back and some, which is very encouraging after you've just been brutalized and destroyed and beaten down and like it
Yes.
seems like nothing you can do is correct or working. Um, you just got to stick with it. So I mean, that's kind of how I got interested in it, and then over time, my strategies have matured. My ability to get more pure exposure um, to the theta. That's something that changes over time too when you transition your account from an
Yeah.
account that isn't able to.
So I think this is a good
Um,
time to kind of explain that. So when you're talking about theta, you're talking about the time that's built into the contracts. Now, if I'm an option buyer, right, I buy a contract, that theta is slowly bleeding the contract each day for a small percentage of its value. But since you're the seller, you are actually benefiting from that time decay that we call theta. And you're now saying that you were trading purely off theta. Some,
Well, no, I never traded purely off theta, but theta is always a component. I mean, you trade options, I trade options. We basically
yeah,
are usually on the opposite sides of nearly everything that we do. And when I say opposite side, I don't mean directionally or our bias within the market isn't necessarily on the opposite side. What I mean is that if you buy a call contract for, Coinbase 2 months out, the expiration is in 60 days and you want the right to buy Coinbase at $100 a share. That's a bullish um, position. You would buy
mhm,
a call contract for the 100 strike, and you'd have that right. Now, me, if if I am bullish in something like a Coinbase, I would guarantee somebody the right to sell me the stock at a lower price than it's currently trading. So I would achieve the same thing, but I would be using a put and I would be selling that put contract and I would basically be taking on somebody else's risk at a certain dollar level. So if someone's been in Coinbase when it dropped down, say when it dropped down to $36, I think it got down to here relatively recently when they had that news
yeah.
come out. Um, Say they bought in at that 36 or $40 and now it's all the way up to $80. Well, they may want to guarantee some downside protection and lock in some of those gains. So they maybe go out and they buy a 70 strike put. And for that, they pay, $500 in premium for the next 2 months. Well, they know that they've basically at that point for the next 2 months locked in their gains from 40 all the way up to 70, less the credit that less the debit that they paid for that put. So they would pay $500. So they locked in from 40 to $65 or a $2,500 profit for every 100 shares. And me, I'm taking the risk off their hands because I'm guaranteeing that I am going to buy that stock if at the end of 60 days, it's below $70. I will take on that risk below $70. Um, so two different or two same opinions were both bullish the stock. However, you can achieve it in two different ways. And so that's what I mean when we're both always on the other side of the market, in that you're buying theoretically unlimited upside and I'm selling a finite reward for my risk. I can only make whatever I sell the contract for
Right.
in any circumstance. And I'm also, so the benefit for me in doing that is I get to choose my probability of success. And I will always have a higher probability than someone buying an option is going to have of being successful. In the end, upon expiration, my probability of being successful is going to be higher than someone that's buying premium. Um, what do, but the market is fair and it doesn't give you anything without taking something. So
Yeah.
what I'm giving up by doing that is I'm taking on theoretically unlimited risk. Whereas if I buy premium, I'm only taking on $500 in risk. Where I'm taking on, if I'm selling that 70 put and I'm collecting $5 for it, I'm taking on $6,500 in risk. Whereas the person who buys is taking on $500.
Right. So here's my so first of all, I feel like it's so unique because I feel like I must talk to so few people that actually don't have much of a technical basis or a fundamental basis, or I feel like I don't know, at least 50% of traders are macro experts, right? After like 6 months of starting to pay attention to the market, they think they know everything. And I think one of the most unique things about you and all the time I've known you, you've always been like, I don't know. I have no clue what's going to happen. This is the probability of this to work out. And that's why I'm taking it. And there must be some sort of bias still that you project on the market when you look at a chart and you say, well, I think I want to be
Yeah,
trending to the upside or the downside. How do you piece that together over the years? Has that just become an intuition for you? Because I noticed like I'm using all this technical analysis and stuff, and we don't talk every day. I say we talk probably like once every few weeks or something. We'll touch base, but we almost always align. I would say a majority of the time with our take on which way the market's likely going to go. If we're both talking about the same time frames, at least.
yeah.
Yeah. So
Yeah, I mean, some of it's just macro being in the market, seeing. I mean, we're both looking at the same market. The market's doing the same thing for both of us, so it's hard not to look at the market and say, and we both use some of the same indicators. Like you're looking at the volatility, and it's a blatant screaming alarm bell when things are going bad, and it's also an indicator of when there's an anticipation that there's not really a whole lot out there to fear. So we're both looking at a lot of the same indicators. I will keep track of volume. So like a day like today, we had extremely light volume. That's something to take into account. Like today is a write off in my book. There wasn't anything that happened today.
mhm.
It was an inside day on the market. It was boring. So I'm not really putting any weight in any type of direction. It's just to sit around and let your positions do what they're going to do. Remember, all the time that the market does nothing for me, that's wonderful. That's great. I make money when the market does nothing. When
Right.
you're long premium, you need moves in order to make money. So an inside day like today, but like I do look at how the indices are performing in relation to one another. Um, and I keep track of how that is going.
So when you
Not
say
not something that I
indices,
write.
so when you say indices, you're
So
talking
like
about like
the
the
Dow,
SPY.
Nasdaq, Russell.
Yeah.
Yeah,
Okay.
yeah. So I trade a decent amount of futures. So I don't usually trade the SPY or the Dow or like the diamonds or the SPY or the IWM. I usually don't use those products, but I trade all the major market indices, the Dow, Russell, Nasdaq, and the S&Ps. Um,
Do you trade those
so
more
I
than
keep track of.
do you trade those more than individual companies or no?
I consistently have positions on in usually the IWM or the Russell and the SPY or
Okay.
the S&Ps. I sometimes will trade the Nasdaq, um, but again, a lot of it depends on where there's perceived opportunity.
Yeah.
So, like an example of that would be right now, you've got massive outperformance of the Nasdaq in relation to the the Dow and the Russell, specifically the Russell. So that's something that, and this goes into kind of also my view on how I trade and how I choose directional bias in the market for stocks as well. So everything is relative. I don't believe anybody knows what's going to happen. So given that, all you can do is basically increase your pot odds. So if, and what I mean by pot odds is basically the the extremes in the market and the amount of money that you stand to make given the capital you're risking um, with any particular position. So like a good example, if I'm going to sell if I'm going to sell a put, if I'm getting bullish in something like Verizon, I'm going to get paid Jack Diddley Bupkis to sell a put in Verizon. Why? Because there's no implied volatility. There's not a lot of interest. There's not a lot of movement in that stock. So in relation to a similarly priced stock of, say, I don't know what even Verizon is right now, but it's probably close to something like Uber. The prices of those two stocks are probably relatively the same. However, I guarantee you, if you were to look at Uber and look at the implied volatility and what implied volatility, what I mean by that is just the expectation of the move over a certain time period, um, and all that is derived from the options that are trading on it, what people are willing to pay and what people are willing to sell the options for. That's where this implied future move comes from, is what people are exchanging the right to buy and sell it in the future. Um, but the risk is the same because let's be honest, even though there's a low implied volatility in Verizon, what's the risk? The risk is that it goes to zero. That's the risk you're taking on. In any stock at any given time, the risk is always going to zero. That is the theoretical risk. So even though I'm taking theoretically the same amount of risk, I'm being compensated significantly more for taking that risk, and I'm able to get my strike price further away from the money and still collect a a significant nominal value against against that risk. So that's what I mean with pot odds. And in my mind, I don't know if this is true. I believe it probably statistically is true, but I also look for discounted things in relation to the market. So like when I look at something like Apple right now, I think, okay, we have a stock hitting all-time highs. So it's trading currently at a premium in relation to the indices that it's comprised of, or that are comprised of it, and a lot that holds it. So do I want to get long, even though Apple never goes down? Do I want to get long a stock that's trading at a premium when relative to the indexes that it's being held in, or do I want to look at a company like a Target, like a Disney, regardless of what you may think of
Bud
them
Light.
and the reasons that they're down, but they're trading at, like, Disney's trading at like a 50% discount right now,
Yeah.
when the index when the indexes themselves are only down, maybe 10% off of their highs.
Out
So
and sorry to interrupt, but I think I want to touch on diving deeper into that because I think that's the true trader mentality as well. Because a lot of people, I think that aren't traders or maybe even some investors would respond to that and say, "Well, don't you want following the fundamentals? Like I hate that. That I don't like that. Ethically, I don't like it. Morally, I'm against it due to the controversy politically that surrounds those companies. I wouldn't touch those and how dare you?" But you're looking at this as the probability of like, okay, these are historically low. I see them as a discount because of I don't even care what happened, but historically low, they're not going out of business, therefore I'm going to take it.
yeah, so like when
Yeah.
I look at it statistically. So my probability of being successful selling a 16 delta put, and delta is just it's a measurement of directional risk in the market. So when I say every every put or call out there has a corresponding delta that measures the
Mhm.
risk. Um, and they're actually, delta is incredible. It's like the most useful Greek out there, because a 16 delta put, if I sell that, it's basically the equivalent of getting long 16 shares of stock. It also is a surrogate for a approximation of your probability of being out of the money upon expiration as well. So all those things are interchangeable. So delta is like, if you're going to be trading options, you need to understand what delta is. So if I sell a 16 delta put in Disney, I run the risk of getting assigned Disney shares. If I sell a 16 delta put in Apple, the probabilities are the same that I'm going to make money or lose money in both of those trades. Just statistically, they're exact same probability. However, the pot odds in my mind, I love the pot odds way more selling premium in a stock that's beaten up. Number one, because there's usually a downside skew in stocks that are going through a period of going down. And skew is just a reference that talks about equal distance away from the money. So if Disney is trading at $90 a share, and I look down here at the 80 strike, and I look up here at the 100 strike, if there were skew, if put skew in this market, these puts would be trading at a higher premium than the $100 calls, and that's just directional. It's an implied velocity of risk that the market has priced in, and we refer to that as skew. So I'm getting paid that skew premium, and my probabilities are the same, and I don't mind taking a stock that's already at a 50% discount. So that's kind of how I build in my biases to the market. It's all relative to what else is going on in the market, where the stock has been. Now, in a company like Disney or a Target or something like that, when I'm trading, I don't have as many qualms about it. In smaller companies that I don't know as much about, I am a little bit more hesitant to jump in just because there are things in the market. Like, let's be honest, like you do need to know a little bit about the company
Yeah.
before you just start slinging puts and calls and selling strangles. Because there are some companies out there that just trade incredibly volatilely, and it's just not the risk that I want to take. The probabilities are the same, but it's not necessarily the risk that I want to take when you've got, pending binary events. Like biotech is a good one that I don't trade biotech. I just don't. Yeah,
Yeah.
you can wake up one morning and the stock is up 100%, or you can wake up one morning and the stock is down, you know, 70%. And with you being short premium, even though the premium is a lot juicier in biotech, I stay away from that because outlier moves
It,
are killers when it comes to being short premium.
yeah, I mean, if we're just even talking options, I don't even trade options in biotech. I'm just a holder. There's not even enough liquidity on most of these biotech stocks, and I guess unless you're playing like IBB or something, there's just not enough
Yeah, I just
liquidity to even make any money off of
yeah,
it. Yeah, and
it's just a good
there's your
example to use of like what, even though the
yeah.
probabilities are the same, there are still things that you do have to be a little informed. It helps having traded things in the past helps as well. Like I find myself putting on positions in stocks that I'm really not that actively involved in. I just want to have them. I want to have them on my screen, so I'll maintain a position in them just so I know what the stock is doing. And it may be a very small position. I found myself buying one share of a stock before just so I can keep an eye on this stupid thing because I'm interested in it, and
Yeah,
it
I've
keeps it
done
on my
that.
screen. My watch list only consists of futures, so I don't have any equities on my watch list. So I have futures products. I've got on. I can just at a glance read down my watch list. I've got the VIX number one thing on my watch list because what I sell volatility. That is the number one way that I make money. So it only makes sense in my mind that the VIX would be, or the volatility futures anyway, is number one on my watch list. Then I've got the four major market indices. Then I've got different commodities, gold, silver, copper, and then the agricultural commodities, Bitcoin futures, and ETH futures down on the list, energy like oil, natural gas, that kind of stuff, and then yields and some currencies. But that's basically what my watch list consists of. And then when I when I look for positions in equities, I actually go out and look for positions. I go out and look for a set of criteria that tasty basically they're basically tasty rules that that have I've kind of adopted and started to use their criteria for looking for trades to put on.
Have you built a scan tool for that? I mean, I guess first of all, give me an example of what those would be. Because are we talking about sector specific rules, or are we looking for like you want the implied volatility of the company to be within a certain range, or historical volatility in a certain range, or a certain percentage
All right,
move
yeah,
recently, or
Mostly it comes down to, well, mostly it comes down to volatility. So
Yeah.
volatility, again, just to rehash on this, volatility, there's several different types of metrics within volatility that get used. Volatility itself is simply the movement of a stock. Implied volatility is the anticipated movement of a stock based off of the option contract prices over a specific period of time. That's the implied. That means, given everything that we know about this stock, the market is pricing in X dollar move over this time period. And then volatility ranking, or sometimes it's referred to as volatility percentile, is a backwards looking metric. It's a number that gauges where the stock currently is in relation to itself historically over a 12-month period. So it says, so like a stock like, um, um, I imagine Apple has an incredibly small right now, being that it's at all-time highs. AAPL. Let me take a look. So being that Apple's at all-time highs, if I go in here and I look at, so it's at 18. It's actually not too terrible. 18th percentile. That means that over the course of the last year, 70 or excuse me, 82% of the time, the implied volatility in Apple has been higher than where it currently is. Now, one of the ways that volatility behaves is that when it expands, it typically expands relatively quickly, and then it spends the majority of the time in a period of contraction. So it expands quickly or relatively quickly, not always. And usually that expansion happens um, when you're coming up to a binary event, or when you get sold off really hard, or violent directional moves. Usually that's when, or there's some type of anticipation in the market.
Right.
Usually that's when it happens. And then over a longer period of time, you spend that in contraction. Well, what do I want to see as a seller? I want to see um, a period of contraction. And it makes more sense to try and take advantage of these stocks that are in periods of relative high volatility or high implied volatility compared to where they have been. So, as a general rule, I'm looking for stocks that have a implied volatility percentile or rank, well above 20. Ideally, 30 to 40 would be great. Um, and then I know that at least historically, I'm getting paid more than I otherwise would have, if not for the majority of the year, to take on that same risk. Um, but for at least a good chunk of the year. So like anywhere from 30 plus, I would be potentially entertaining that as a trade that I might want to get into. Um, Now, you also do have to look at the amount of premium you're able to collect for the capital that you're going to put up.
Mm.
So like if you, again, going back to something like Verizon is a low volatility stock, even though they might have just recently had like a really bad earnings announcement and they got destroyed or whatever the case is, they may have an implied volatility compared to themselves historically. So they might have like a 50% IV rank, but it still has to be worth you taking the risk of tying up that capital in that trade. If you've got this stock with very, very low raw volatility, and even though it's a high rank, it might not be a good candidate. So there's a balance between finding stocks that are in a period compared to themselves historically that are elevated, and the most bang for your buck, because nobody has unlimited capital, or nobody that I've met yet. And you got to make that capital work for you in the most efficient way. So it's a process of finding like, okay, this is a candidate, this is a candidate, this is a candidate. I've got 5 candidates here that are all, they meet that criteria, but now what are what are the capital requirements in relation to how much money I could potentially make? So that comes into it as well. And every brokerage firm is going to charge you a different amount as well. They all have a basic minimum standard. So like what, and that's something that probably most people don't have a good understanding of
No, no, no.
when it comes to selling premium. So when it comes to selling premium, if I'm we use Coinbase and selling the 70 strike put earlier as an example. What I mean by the capital requirement is these even though I'm taking on the risk when I sell that 70 put and I collect $500, that means my risk is $6,500. If the stock goes to zero, I lose $6,500. Even though I'm taking on $6,500 in risk, the brokerage firm is going to look at that position and they're going to make me allocate a certain amount of buying power reduction, or BPR, I refer to it as. And they're going to do that based on the distance from the stock price and the volatility of the stock. So the historical movements of the stock, some stocks, they move a lot more than other stocks. The brokerage firm may deem this a more volatile stock and a riskier stock, ergo, they may require more buying power reduction for me to maintain that position. But on, it's typically about 10 to 15% of the strike price is probably a good shooting point when just kind of off the cuff calculating how much is this position going to cost me. So you
It's
now
10 to 50% of the
Coinbase,
strike price. So 15% of what you
yeah.
pay. Okay. Is what you're
So
going to
the
need to
brokerage
keep
is
in
going
the
to
account.
require, yeah, the brokerage firm is going to require typically 10 to 15, maybe 20% of what the strike price that I'm selling naked is. So like for now, this is a bad example in Coinbase because Coinbase is a very volatile stock, and the brokerages, all of them require more than that. I think it's probably closer to 20 to 25% of the strike price. But typically, with most stocks, um, like if you're looking at an Apple and you're trying to sell the 150 strike put or the 160 strike put in Apple, you could expect that it's going to require you to put up $1,500, $1,800 in buying power to maintain that position. And the brokerage is coming up. They do have regulatory requirements where they have to keep a minimum, but where it'll get you is they can increase that. So like for their own risk, they can say, okay, this guy's slinging naked calls in Tesla. We view this as a more risky stock. We're going to require that they put up, 2 or 3 times the normal amount just to secure that position. So that's what I mean with deciding whether or not, like, Tesla is a very volatile stock, but it's also more capitally intensive to trade. The premiums in there are great, but you pay more to get that exposure in the amount of buying power that they require you to set aside.
Yeah.
But that's basically how it works. And it's a weighing of the two and finding out where's my biggest bang for my stock or for my buck. And it's also, for me anyway, I've traded pretty much all of the popular stocks, and it, it's also a matter of, for me, just knowing the stock. Like the more comfortable I am trading it and having traded it in the past, I don't know, it's a mental thing. It doesn't probably make sense on paper and statistically. Like it's probably something I shouldn't do, but for some reason I find myself being much more willing to take risk, in larger amounts in stocks that I've traded before, become familiar with. I think I know how they're going to behave, even though the entire thesis of my trading style says that nobody knows how a stock is going to behave.
Yeah.
But I will
But
weigh that does unfortunately come into my decision making process as well.
and that makes a bunch of sense to me because I had the same sentiment. I feel like I've specialized in some of these companies to the extent, I've traded them so much that I feel like a lot of these stocks, especially Tesla, have also developed their own ecosystem. And so you start to get a feel for how these investors react to things, and then you get a feel for how the stock's going to likely move or on what news it's likely going to do. And there's also, there's people who've built YouTube channels just off the intuition of how the stock moves and the knowledge of this little miniature ecosystem within the greater market that exists there. So yeah, no, I completely understand what you're saying, and I think that there's a strong base case for it. I think if you did a bunch of research on a guy trading 100 different stocks and his performance for someone only trading 10, I think the 10 is probably going to win, just because he's more hyper focused on the movements of just 10 companies and prevent them both from. I'm I think that you would probably need to see the research, but that's what I would assume intuitively would be the case because of the specialization leads to, a better understanding of what's going on. So that makes sense to me. And that's the way I always tell new people when they join the Discord too. Is like, hey, watch the index and then like watch a few companies you like and feel like be able to start to explain why they moved when they moved. Of course, that wouldn't be helpful to someone like you because you don't care at all about that. You just watch the probabilities. Yeah. And
Yeah,
I
I
think that's,
mean,
yeah. Now,
yeah. So
how
go
often
ahead.
these days are you naked? Um, not out in
Ninety
public, because
percent.
I know that's frequent, but I meant like in the market. Yeah.
Like 90% of my positions are naked, almost all of them, or they have an element, or I'm combining spreads with a naked element to a trade. Um, but yeah, and there's a reason for that. If you have the capital to trade naked and you understand the probabilities, you stay small, as opposed to trading spreads, you're getting pure exposure as opposed to a segment of exposure. Now, like when you do a spread, going back to Coinbase again, since we're using that, if I'm selling the 70 put and I'm buying the 60 put, that's a spread. So I've limited my risk to $10 or
Mhm.
$1,000 because I bought protection. I
And then
bought
you
a
no
contract
longer,
that gives me the
yeah, then you no longer have that
yeah,
unlimited risk as well. Right. Yeah.
correct. But I give up. I give up a lot by
Mhm.
doing that because I'm paying maybe $2 for that 60. So I'm giving up $2 in credit. I'm getting in return for that a limited amount of risk. So now we're looking at, collecting $300 and having $700 of potential losses. That's my max that I can lose because I keep that 300 no matter what. And I could, if the stock drops to 50, then then I don't see any of the losses below where I have the right to turn around and sell that stock at 60. Um, but I also give up probability of success because now my cushion for that stock is where I had a $5 cushion from the 70 strike price. Now I only have a $3 cushion from the 70 strike price. So the probability that it's going to reach my break even point and my break even point itself changes when I buy that protection. Not only that, the protection and the uh, the the short strike are working in tandem. So when one goes up, the other one goes up. When one goes down, the other one goes down. So you're not going to get for a directional move in your favor in the market. Yeah, your short strike or the 70 strike put that you sold is going to become significantly less valuable, but so is your long strike that you bought. So that's going to reduce in value. So you're not going to achieve your profit nearly as fast when you spread off something. You're not getting pure exposure to directional risk, and you're not getting pure exposure to the theta risk because you have a element of that theta, even though it's a smaller element, that's working against you on the long leg that you bought for protection. So you have two competing um, deltas. You have two competing thetas that are working against each
Sure.
other, and you don't get the same level of exposure. And that
Now,
so if you can manage your risk and you can be comfortable selling naked, your probabilities increase and your time in the trade will decrease. And I just think it's a much smarter way to trade.
no, it's the way that I can, as a buyer, actually eliminate my theta. And with if I'm buying those and then selling it. And how many times are you? Well, I
There's
guess
another way that you can eliminate your theta and be long premium.
being synthetically long. Is that what you're talking about? Or
Well, yeah. So there's a strategy called a zero extrinsic value or zero extrinsic back ratio or zero extrinsic value back ratio. And basically, it's buying a long spread in conjunction with buying a naked option. So the at the money short that you are selling in your long spread that you're buying is at the highest extrinsic value strike, meaning at the money. So you're selling the most amount of extrinsic value that you could possibly receive, and then you're buying two deep in the money, not deep necessarily, but two in the money contracts. And if you finagle it correctly, you can account for all of the extrinsic value of the in the money strikes. Because what happens when you go further in the money, you get less and less extrinsic value in those in the monies. And they begin to behave more and more like a
actual
synthetic
stock?
stock.
Yeah.
So you can cancel out all of your extrinsic value in your two longs that you buy if you sell one at the money short against it. And it gives you a pure 100 delta with zero extrinsic value.
Yeah. 100 delta might throw people off, but that's just a point one. That's just basically what a
It's
stock
just, yeah,
does. A stock would be considered to have a
yeah,
one
it
delta.
behaves just like a stock.
Yeah.
It's
Because
a
for,
replacement for a stock.
yeah. Yeah. Cause, yeah. So, I mean, if they're at this point, they probably know what Delta does. But if you got in here and you're confused about Delta, the way that I think about Delta at the most basal level is like this number signifies how much my contract goes up or down in value per $1 move within the stock. And you look at it more of like the probability of success or failure, which I do in some regards
But
as well, especially if I'm
I,
setting up like pair
yeah,
trades or something. Yeah.
I
So,
look at it to be honest with you, the biggest thing that I use it for once a trade is on is just risk management. So like if I have a stock where I put on a neutral trade is when you sell both sides. So I see a stock, I don't necessarily have a bias, but I think it's juicy and I think there's a good premium in there to be sold. So I might sell a call and a put, one above the stock price and one below the stock price. So say you were selling the 70 um, put in Coinbase, maybe the 100 call in Coinbase. That would be, depending on the skew, that would be ideally a bullish trade. It depends on the skew, though. It could even be a neutral trade if the stock is trading at 80. But say it was slightly bullish. So say the delta that you sold in the put was um, uh, 20 and the delta that you sold in the call was 15. You'd be long 5 delta. And
mhm,
that is a living number that changes on a daily basis depending on what the stock does. But it also tells you your directional risk in the stock throughout the term of that trade. And I'm usually selling about anywhere from 30 to 60 days out. So these trades are on for a while and they require management. So I use that delta as okay, I started this trade as a neutral ish trade, slightly bullish. If the stock then moves up or down, I need to adjust my delta to keep it in line if I want to maintain the same position. Otherwise, I no longer have the same position. I'm then becoming bullish or I'm becoming bearish if I just let it sit. So you can adjust by buying back the contract that is performing well, having less value. One of the contracts is losing its value as the stock moves and you can buy that back and sell closer to the stock price and increase the delta on that particular side and rebalance the trade as time passes for that trade. And I'm constantly doing that throughout the month with all of my positions. I'm rolling up puts or rolling down calls
yeah.
for whatever side is not being tested.
And so I think
And
that's,
delta is how you keep it.
yeah. And so you kind of you mentioned earlier that you're trading volatility. You want stocks that are relatively high in volatility. You're trying to stay away from um, penny stocks and such, right? You actually want to get paid well for what you're looking for. And then you just mentioned there as well that you're typically 30 to 60 days out, right? So you're doing a month or 2 months. That's your like, and you're mostly naked on those positions as well. So how many times how are you, let's run through, you have a 60-day position, the delta is going against you. Let's say you sold the Coinbase $70 calls, it goes aggressively against you. How are you managing that position if you're naked right there? The stock starts,
So if I had
yeah.
the first thing that I'm doing is if I just sold the 70 call, say when the stock was at 40 or 50 or whatever. And I sold the 70 call. I took a directional shot and I'm wrong. So the first thing that I'm doing is I'm selling the put. I'm increasing the amount of credit that I take in, and by doing that, I'm increasing my break even point and also increasing the probability of success. Um, in that direction, in the upwards direction, because it's not performing the way that I want. Now, I'm actually probably reducing my probability of success because now I can lose in two directions when I sell the put. But I'm not worried about the other side. I want it to come back down, so I'm selling the put, and I'm selling that put relatively aggressive if the stock is moving aggressively against me, like you're saying. So I'm selling somewhat close to where the stock price is currently at And I'm doing this relatively soon. If a position goes immediately against me and there's a large move, um, I'm I'm trying to be proactive in selling premium, always increasing my cost basis on that trade, increasing my probability of being successful. And then if it continues to move, I'm rolling that put up even higher to the point where you could be in a straddle where you've got your put and your call both at the same strike. If it continues to move against you at that point, and my delta is still, I'm getting shorter and shorter, and the stock price continues to go up, I will do one of two things. I'll consider either becoming inverted in the strangle, and inversions are never fun. It's never a good day when you go inverted. Meaning, so originally I sold the 70 call, the stock price was at 50, and now the stock price is at 75. Since then, I've sold the 40 put, rolled it up to the 50, rolled it up to the 60, rolled it up to the 70. Now both my strike and my call are at the same place. I've collected maybe $7 on this position, meaning my breaking point to the upside and to the downside is $7 above and $7 below. So I can only make $7 total. So I have to then make the decision, do I want to roll up to the 75 and go inverted by $5 and take in another $1.50 credit, or $2 credit? If I can take in $2 credit in doing that, then now I have $9 total, but I'm $5 inverted. So the most that I can make in that position is $4 at that point, or $400. If the stock price comes back down anywhere in between my inversion, the most I'll make is that $400. Or do I go up to the 80 and just try and salvage anything that's left and maybe collect another $3 or $4? And basically, that's just you're locking yourself into a best case scenario of break even. The other option is that you can use static delta. Um, and the difference, static and dynamic, when you refer to options, it's a dynamic delta, I mean it changes with the stock price. Static delta is the stock. So when you buy stock, you statically are long, and that never changes. You're always going to be long one share of stock. So if I've rolled up to a straddle and the stock price still is not cooperating, then I'm going to try to reduce, usually, especially if it's a violent move, I'm going to try to use stock, buying long stock, to reduce some of my directional risk in the trade. So if the stock continues to go up and work against me, that stock delta, that static delta, is going to help offset some of the losses if it continues to go up against me. And depending on how far that goes, I might end up buying, 10 shares of stock all the way up to 100 shares, and be caught into just basically a covered call at that point.
Okay. So when you're so interesting, I so
Usually it's not that extreme where you're buying 100 right off the
yeah.
bat. Usually it's a process. And usually, ideally, I've gotten better over the years of kind of incrementally adding static delta and to a position. So I'm not just like waiting till I'm already at my strike. I mean, sometimes you wake up and it's there and there's nothing you can do. But
No.
I usually try to incrementally do it in small increments.
Yeah, so and I'm also surprised that you aren't um just capping it immediate as sooner as well. So your
I'm a glutton
preferred,
for punishment.
yeah. So like just setting up a spread and just like, okay, I'm gonna define this risk to stop the bleeding, and maybe
Well, you can do
but
that, but the problem with that is
you're not making much.
if you cap it after you've had the move against you, you're
You're pretty
paying
much
twice as
locking
much for
in,
the protection at that point. Yeah.
yeah. Then you're locking in
So
the
you're gonna
losses
pay
too. Yeah.
yeah, you sold this 70 strike call for $2 when the stock was at 40. Now it's at 60. It's going to cost you $2 to buy protection, $10 away from that at that point. So you have no profit potential. Um, you can do that, but if you're going to do that, in my opinion, you might as well take your L and get out of the trade.
Just get out of it, yeah. Just buy it back.
Yeah.
Yeah. No, that makes sense. Um
But I'm a
that's
glutton, like
it's
like I said, man. I am a glutton for punishment. I don't know
yeah.
when to leave a trade. Like I will fight till there's nothing left. It's call it a character flaw or whatever, but
No.
I'm buying stock, I'm rolling up puts. And sometimes, and again, this goes back to trading incredibly small. sometimes I'll sell a couple of puts against my if I get a very violent move and there's good premium in there, I might sell two puts against one call and have it ratioed in that sense and just take on more risk back to the downside. Especially if it's a stock I don't mind owning for the long term and I know I can sell calls against it if it does drop and I get assigned those shares. I'd much rather in some stocks be long the shares at a lower price and be able to sell calls against it if I don't mind owning the stock than be on the wrong side of it when it's ripping to the upside. Upside risk still is scarier to me than downside risk. I don't know why. It's just it's it's GameStop is what it is.
Yeah,
It
yeah.
was being on
It's
the wrong side of
trauma.
GameStop, man.
Yeah,
It was
bubbles.
I think that's honestly what it is. But like
Yeah,
for some reason, mentally, it's harder for me to digest being short a stock that's taken off than it is being long a stock that's getting beat up.
yeah. Okay, well, the market also just inherently melts up. So, people's 401ks, all this incremental passive buying that occurs no matter what, it's just going to go up eventually. So it makes sense to me. Even, if you just treat it like a mental puzzle. So you're about 60 days out, usually naked on your contracts. We just heard how you would handle one that was growing aggressively against you. Now, how many plays are you typically keeping in your account at any given time?
I trade multiple different accounts. I have like five different accounts that I trade.
All with
And
different strategies, or do they have different
um,
designations? Or
two of them are very similar strategies. One of them is um, one of them is a little less risky. It's just more like I'm further away from the money in them. I keep more capital on the sidelines. It's just more of a straight theta type component with the um, occasional index, just directional slash theta play on there. The other one is just straight a free for all. It's like anything I see. It's my main account is I'll have on 30 positions at any given time to I don't think it
that's
ever gets really
wild.
below I don't think it usually gets below 25, but anywhere from like 25 to 40, 50 positions um at any given time. And remember, longevity. I trade very small. So
Hmm.
if I'm taking $250 out of a stock, unless it's something I have really high conviction, that's a win for me. Like if I'm taking $2,000 out of a stock, it had to be something that I had super high conviction on, and it was just like in my mind, a no brainer, and I increased my size on it. So I'm playing. It's a numbers game. It's the law of large numbers. When you're dealing with probabilities, you need a high frequency of occurrences over a long period of time with the statistics in your favor, like a casino, in order to see the probabilities play out. And if you're only managing five positions, well, you could statistically have a great chance of being successful, but statistics don't mean anything without a high frequency of occurrences.
Yes. Yeah. Need that large enough net. Up, cover all
So
the
and then I have an
probabilities.
account that I just do. I have an account where I just do straight stock, where I just buy stock. That's it. Um, and then I have another account where I do mostly stock with the occasional options play whenever I think I see something that's a blaringly good um, risk reward.
Okay. Are these all brokerage accounts? Are some of them 401ks or Roth IRAs? Or I mean, it's probably not
I do
401k, but
trade. I do manage my own like Roth and all that kind of stuff, but I don't.
okay.
That's more of a. I so with a Roth, I use longer term strategies where I'm buying like lead options because the thing with a Roth is because of the regulations, you don't get to appreciate the same um, buying power reduction. It's cash secured. So in order for you to make your money work most effectively, i.e., leverage, you have to use different strategies in something like a Roth, um, where you can go out long time and then buy a buy a call in a company you like and then sell premium against that in the near term. So you still can do spreads, you still can do a lot of different strategies, but it's not margined the same way. So you have to create synthetically these strategies that you would use in a margin account. But yeah,
Okay.
there are also
Yeah.
I use different brokerages. I use TD, I use Tasty. I recently started playing around more and more with Webull. Um, and then
Okay.
funny enough, I use Cash App.
Oh, I
I
think
found that
yes.
Cash App is an
Yeah.
amazing, and then I also use Acorns too. Like I have just like that the app that rounds up for your credit card.
Oh, okay. Yeah.
Like
Yeah.
every time you swipe your card, it throws money in there. I mean, those that I don't even look at. It's just like something that I figure why not? It's a good idea to have, and it
Do
just
those
continues to
let you
squirrel
pick?
away money.
Can you pick stocks on Acorn? Is it just passively
No,
buying the
you
index, or
pick a
is it even more
yeah,
broad than that?
you pick a risk profile
Okay.
that you're
It's
willing to accept, just like
it's
your
like a
traditional
401k
you would do
basically
at
that
work,
for pennies.
basically.
Yeah. That's
Yeah,
funny.
but it adds up over time. I mean,
Oh yeah.
over time, it's ridiculous how much I have in there from just, a couple of bucks here and there. After you've done that for years, it's like, okay. So I've thought about taking that money out and trading with it, but I'm like, yeah, we'll see how it goes. But yeah, Cash App though, anytime somebody pays me on Cash App, I don't take the money out. I just go buy stock. And
Yeah.
over the years, that is um, really added up as well. So I
That's
love the
awesome.
fact that you can buy fractional shares on Cash App too.
Do you own
And
any
now
crypto?
I've got my kid.
Do you own any
Do I own
crypto?
crypto?
Because you can buy crypto with that too. Do you own any?
Yeah, you can. I think you can only buy Bitcoin on Cash App. But yeah,
Oh,
I
okay.
use
I didn't know that.
Tasty. Tasty has the ability to, you don't actually own the crypto, but you can trade crypto. You get exposure to the crypto. So
Oh,
you can,
okay.
and they have probably like 20 coins that are available on there. And I do have exposure to Bitcoin, Ethereum, Litecoin, and I don't trade it much. It's like less than 1% of what I do. But whenever it goes down, I'll start buying it slowly. And whenever it goes up, I'll sell it out.
Yeah. A
I'm
lot of
addicted.
the a lot of a lot of the hardcore crypto guys are going to be really upset to hear that you don't own your crypto and it's not like in a wallet buried, underneath the ground,
I'm sure. Yeah.
beneath
Well,
the
no,
ocean.
it's
Yeah.
something that the size of which I trade it is something that I could lose it all tomorrow and I wouldn't lose an ounce of sleep. I don't, like I said,
Yes.
it's less 1% of what I do. It's just more of an engagement thing for me to know what's going on with it, so I can have it there to see it. And I will trade the futures. I will trade Bitcoin futures and Ethereum futures
No.
because
Hey,
they have relatively liquid option chains.
I've actually never traded the futures there. Maybe I have to look into. Maybe I should look into that actually, because I'm expecting some moves there soon. Some
Well, that's
juicy
and to
moves.
be honest, that's one of the biggest reasons that I don't trade crypto is because there are not liquid option markets available for them. So when it comes to
Yeah.
strategic investing and strategic trading, you don't have the ability to do that. It's either you like it and you're long, or you're a technician and you're watching the charts, which I'm not. So you can't really be that strategic when it comes to crypto. You buy it or you sell it.
Yeah. Yeah. That's
Yeah.
that's all I've ever done. So you also mentioned your kid, teaching your kid to what through
Oh
Square or
yeah,
just getting them involved a little bit over time. Because I don't
yeah.
think because we didn't really mention that. We
He's
talked
up.
about your story, but you're a father, you work a lot, you have a lot of stuff going on, and you do this all as well. Because a lot of people have the um especially when they hear the term day trader, they imagine a guy from open to close just staring at his computer, and that's all he ever does. And if he looks away for a second, he'll lose all his money. And I mean, that's probably the
I have
lowest common
people.
denominator view. But yeah, yeah,
I have people all the time ask me, "Oh, you day trade?"
yeah,
I'm like, "Well, not in the sense that you probably think about it, because like,
yeah,
yes, do I day trade? Yeah, I'm in and out of trades on a regular basis every day. However, it's not like as glamorous as what you have in your mind when you say, "Oh, you day trade." No, my position sizes are small. I'm making a lot of adjustments. If I see opportunity, I might take advantage of it, get in and out the same day. But like, it's it's all it's all within my size parameters, which is very small for any singular position.
no. But
But like when it comes to my, go ahead.
but at the end, but over a period of several years, would you say you've made more than people who are just invested in the index? Has your account has
Yeah,
compounded though from your skill sets,
yeah,
probably likely. Yeah. So
yeah.
how much percentage of your when the year starts, how much percentage increase do you think you average over your total account from option selling?
I,
Do you
it
even know? Is it
depends. I
just
mean,
some years are
I've
just
been,
crazy?
yeah.
It's yeah, too hard
So,
to come.
well, I mean, well, yeah, like this year I'm up over 100%.
Nice.
But there's
Six
been
months, 7 months
years
in. Beautiful.
where I've lost money. So I mean, like it's
Yeah.
hard. And again, I haven't been doing this for like 20 years. I'm I'm relatively young, and I waited way too long. Oh my goodness, I wish this were something like that my parents and my educators had had the knowledge of and the experience to share all this stuff with me, because this is like invaluable information that, like, if I had had a little motivation to get into, I can only imagine where I would be had I started 10 years sooner. Like, I've been doing it for, at this point, 5 6 years now, but a lot of that was, I mean, I'm still learning, obviously, but a lot of that it takes a while to figure out like what you're doing, what works for you, what you're comfortable with. And then while you're doing that, the market's crashing, COVID's happening, you've got all different kinds of geopolitical things going on, and the market's going crazy. So it's like, how much of this is what you know and what you're good at, and how much of it is, outlier events, especially when you're selling premium. Outlier events make it very challenging to take advantage of. Now, towards the end of an outlier event, you have massive opportunities to sell premium and make a lot of money. But during the event, you're usually getting your face ripped off in defense mode the entire way. Defense, defense, defense. So like, yeah, there's been a lot that's happened over the last 6 years. So to get into the market, there were years where, you know, I did what I thought was relatively well. You know, I'm shooting every year for somewhere around that 20%. If I can make that 20%, then I feel like I have done well, just because I think that's a realistic goal to achieve over time, something that is repeatable. However, like I said, there's been years where I've lost money. There's been years where I lost a decent amount of money. And there's been years where, again, I've made a ridiculous amount of money in relation to the amount of money that I trade with. And I keep my account sizes at basically the same size. I do scale them up slowly over time, but I try to keep my account sizes relatively small, because it's a comfort level with the amount of risk that I've taken. So like, after if you're trying to stay small and you get used to trading small, scaling up is something that, like, once you're comfortable with your trading style, with risk, you understand what risk is, how to defend it. Scaling up for me has been something that has taken longer than I would have thought. Like, people think, okay, well, if I can make 20% with this much money, it's the same thing to make 20% with this much money. And
Oh,
theoretically, yes, it is. However, the mentality and the mental process of getting to that point when you're increasing your size, for me, it's taken time. Um, and I think it's probably a smart and a good thing for me on that behalf, because the longer I trade in the market, the more that I realize that the market can do anything and nobody knows what's going on. So again, going back to the longevity, I'm not in a hurry. And that's one big thing that the market has taught me. If you're coming in this market to make money fast, you're in the wrong place. Um, it's about the longevity. It's about being able to survive to fight another day, um, and being able to take your little wins over time. And over time, those little wins add up to big wins if you can be consistent with it.
oh yeah, absolutely. So, yeah, absolutely do. I like your slowly get rich. I had the same mentality, even though I'm not, that's the same trading style as you. Um, but so
That's what
what?
everybody coming into this game doesn't have that mentality. Like, nobody comes into the market and says, I'm going to be a trader, and thinks to themselves, I'm going to take small little wins over time. Everybody coming into the game thinks, I'm going to
Oh,
make good money.
oh yeah, it
Yeah.
was
And
beaten
then,
into me. It wasn't a willing decision. It came through. It
well,
came through a few beat downs where I was like, oh, okay, you
well, that's
win.
why
I
that's
get
why I
it.
was kind of harping on it, because, like,
Yeah. Oh
Everybody, it's
yeah.
not, you're not unique. If you're thinking about trading and you're coming into trading, you're not unique to have these thoughts of grandeur and making all this kind of money.
Oh
And
no.
you're going to have the natural instinct to want to win big. You're going to have the natural instinct, and you're going to think you're failing if you're not winning big. When you get your face ripped off for the first time, it's going to be your natural inclination to quit, to think that you don't have what it takes and to stop. I've talked to hundreds of people that, and the story is always the same. Oh, well, I used to be into trading. I used to trade crypto. I used to trade the market. A couple of years ago, I got into that, and it's always the same thing. I was doing well for a while, and then basically it's people that didn't know what they were doing. They were just participating in the bull market, and then things didn't work the way that they thought they were going to work, and then they quit.
Yeah.
So I say all that to, for the people out there that actually are trying to get into it or want to expand what they do, it's completely natural to have all those desires to make that money. And you're also going to, everyone in their trading career is going to reach that point where they want to quit, where they don't think they have what it takes, where they think they've been beaten. And it is inevitable. You will arrive at that point at some point. And that's the make it or break it between who's actually going to be a trader and who's going to go home and sit on their couch and just let some guy that doesn't know any better than them manage their money in their 401k. And their main purpose is not to make you money, it's to preserve capital and to keep you as a customer
And the
and
market.
get more assets under management. Yeah.
And to be a marketer. Yeah. A salesman.
Yeah,
Come put your money with me.
exactly.
Yeah. And a lot of them don't know any better. There are some that are exceptional, but they're a lot fewer than
Yeah.
people
Yeah.
even think. Yeah, and so
Yeah.
it's way fewer than they think. I know some people who, it's ridiculous to us, right? Because we're so saturated in the industry, but some people even tell you, well, I've got a financial advisor. It's like, that's not even like,
Give me
even
a
if
now.
even if you're talking to someone who manages a hedge fund, I'm still going to be skeptical. But your average financial advisor isn't going to know anything at all.
Yeah, your
You
average
know?
like, if I told, when I talk to financial advisors,
Yeah.
like, and describe my portfolio, I can hear like the heart palpitations. Like,
Oh yeah.
they, just the amount of risk that they perceive what I do. And see, I look at what they do and I think there's so much more that you could be doing with your customers' money to maximize, your chances of being successful. They look at what I do and they see insane risk.
Yes.
Whereas when I look at it and I see comfort with the level of risk that I'm taking because I understand it, I know it, I know how to manage it. So
Yeah.
it's, experiences may vary, I suppose.
Well, yeah. Well, your experience will vary your outlook on it. And
Yeah,
and to be fair to them, some of them are dealing with people's retirement money. So, it puts you in a
that's true
different
as
it
well.
puts you in a different mindset. If this person loses money, it's the only money they're ever gonna make for the rest of their lives. So it has to last. It
That's
has to.
very true.
Yeah. And
I
so
guess
continue.
I was talking more to the younger generation out there. I imagine that's probably a good chunk of your audience. And to
Oh
them, I
yeah.
would say that now is the time to take risks. You might think you don't have enough money, you don't have enough free capital. I would tell you that you will never have enough money until you make it a priority. Once you make it a priority, you will find that you had the money all along, even if it's just a small amount to start with. And now is the time to start taking the risk. Now is the time where it is going to pay off, uh, a thousandfold over the course of your life. Even if you're not successful right away, the education that you will get along the way when you learn these skills are invaluable and they can never be taken away from you. Once you understand it, nobody can ever take that away from you. You literally have access to the most liquid markets in the world at your fingertips on your phone, with access to all of the information that you need for free out there on the internet. Everything, the barriers to entry to the market are at their lowest point than they've ever been in all of human history. And all that's required is for you to participate and be patient and educate yourself. And it's something that will benefit you for the rest of your life.
The rest of your life. Yeah. And with the way things are headed economically, the way inflation is, with the wealth disparity continuing to grow, it might be your only way from the next 40 years to even just stay above poverty, is to actually be involved in the market. Real wages aren't going up. All these
Yeah.
big, the government makes most of their money from stock market tax, from capital gains taxes now. That's they make more money off that than actual income taxes from working Americans. So, to think you don't have to get involved in the market or you shouldn't have to learn this, if you have the aptitude, I think you have a responsibility to learn at least a minimum, because 20 years from now, you're going to feel, or 50 years from now, you're going to be so grateful you did, and learn about crypto a little bit too. You'd be so
And
grateful. Now,
generationally too.
yeah.
Generationally for your children. If you don't have children,
Yeah.
if you ever think that you may want to have children, you owe it to your future generations to be able to provide them the education that will set them up for success early on in life. It goes back to, I was telling you, my son, I would take him around to thrift stores and we would buy just random knickknacks and put them for sale on eBay. So I'm not just giving him the money, and he would sell things on eBay, whether it's a tennis racket or a golf club or anything that he finds that we think that maybe he may be able to sell for a profit on eBay. And he's done that now several different times. And when he gets his money from selling those items, he goes on to his little Cash App account. He's up 21% this year.
Oh, nice. That's
21%.
fantastic. Yep. I bet he's so excited too. Good. It's good
Yeah,
he's
and
getting
it's just
involved.
like to teach him that that's possible, and he's 9.
Yeah.
To teach him that that's possible, that's going to be something that will shift his mindset for the rest of his life, and he's not going to think, um, well, he probably will think, what video game can I buy with this and all that because he's still a
Oh
kid.
yeah. Oh yeah.
But he's also going to have it in his mind that like I can have this money be working for me and I can manage this money. I know that I can do it. I've done it even at a young age, and that's going to pay him for the rest of his life.
Oh yeah. Absolutely. Yeah. And so before we wrap up, I can't do a podcast with another trader and not ask them about the market right now in real time. So right now, what is your positioning? What are you looking at in the market? What does your positioning look like? What's a trade you really like right now? And then,
I've kind of already mentioned trades that I really like. I like
yeah.
Disney long.
Okay, yeah.
I like Target long here. I like I like the yield curve, uh, playing the yield curve for some type of revergence, meaning uh, a narrowing of the inversion. So right now it's inverted about 1%, and continues to widen. So as it continues to widen, I'm legging in to a trade that makes money when it comes back to normal.
Mhm.
That's one of my larger trades is the yield curve,
And you're
and that's
trading,
just it's relative.
yeah. That a lot of people might not understand that, and I don't know if we should actually do a full breakdown of. Do you think you could do a quick description of what? Probably not. Let's
Yeah,
not
so
do
like,
that. Okay, go ahead.
well, they can make it really simple. So right now, so the securities that the government sells, they they yield a
Pause.
certain interest rate. Bonds, yes.
Yeah.
Typically, the longer you're willing to tie up your money or give your money to the government, they're going to pay you a higher interest rate for it. And if you're willing to do it for a short term, you're going to get paid less of an interest rate on your money. Now, with the economy, we've seen that 2 year and the 10-year bonds invert, meaning that the 2 years are actually paying, you're getting paid more to tie up your money for less of a period of time than if you tied it up for a long period of time. And that goes back to the whole when everybody's talking about the yield curve inversion and recession, that's what they're talking about is the fact that people are getting paid more for short term lending to the government than long term. So I'm just simply saying that over time, I think that as we normalize, there's profit to be made on the 10 years going up and the 2 years coming back down. Whether or not that happens in that order, it doesn't matter. It's a pairs trade, meaning it's only the relationship of the two of them, or the relationship between the two of them, the 10-year and the 2 year, that you're getting exposure to. So you're only trading what's known as the spread, their
Mhm.
relationship between each other.
Yeah.
I don't know if that makes any sense to some
No, I
people.
think that was pretty good. That was really good. Yeah. So you like you're doing the 2 and 10 year, right?
Yeah.
The difference between the 2 and 10 year for that trade. Yeah.
So you can trade it a variety of ways. I'm actually trading the yields. You can trade the bonds too. You do the opposite
Yeah.
if you're the yields and the bonds are opposite of one another. So if you're trading the bonds, you would put on the opposite position that I have on.
So what about the indices? Because you like to trade the indices. What's your bias? Do you have a bias right now for a long or short?
I'm pretty neutral. I am leaning long, slightly long in the
Russell.
both of the indexes actually. In the Nasdaq, I'm leaning slightly long, but I'm doing that with um, out of the money short puts. So I've sold out of the money puts to finance at the money long call spreads. So all of that for a
Okay.
credit. So it's not a huge directional bias that I'm taking. I still have room to the downside. Um, and then I'm kind of straight neutral on the S&Ps. Like I have strangles on in there. Um, so not really a lot of directional risk in the S&Ps.
Does that
Um,
represent the
I don't have anything on
uncertainty?
in the Russell right now. What's that?
Does that represent the uncertainty you're feeling in this market right now? Being neutral
I
like
feel like
that?
we're a little short term overdone. Yeah, I feel like we're a little short term overdone. I feel like we could be in for a little bit of a pullback, but I don't see anything. And again, I don't believe anybody knows anything, so take that with for what it's worth. My
Yeah.
position sizes in there are small right now because of the fact that volatility is low in those indexes. And when you trade the way that I do, the lower the volatility, the more you want to lighten up on position sizes. The higher the volatility, the
Yeah.
more risk you want to put on. So I am relatively small and relatively neutral. I do think it's likely that we see a little bit of a pullback, but who knows? With this market, we could just creep higher. I just don't think it's going to be too crazy. But that's just my opinion. That means nothing. Um, and then what else am I? As far as other positions, I'm slightly long China. And again, that's
Hmm.
just a relative trade. Um,
I
which
like what
probably
through what? What how are you long China?
I'm long FXI. I'm long
Okay.
FXI with leap options, so leap spreads out of the
Oh
money.
wow, you bought
Um,
leaps? Okay.
yeah, I'm going down with the ship, man.
All right,
Um,
let's do it.
I trade Billy and I trade Baba,
Okay.
and I'm short puts in Baba, and I am long covered calls in Billy. With Billy is everybody knows what Baba is. People probably don't know what Billy is. It's just like it's kind of like a Chinese YouTube.
Yeah.
Um, what else? I've got, some of the Googles, Amazons, that kind of stuff on, just very light exposure to those,
You traded in
slightly
any of the
long leaning.
AI hype? Are
I
you
just
in?
got short AI today. The actual ticker AI I put on the,
Okay.
I've been trading that, getting in and out of it. Whenever it pops, I usually will lay out some premium, sell some naked calls. I did a ratio spreads in there today. So I think that's probably beyond the scope of what we want to get into. But basically, it's a zero downside risk trade. So you're taking no risk to the downside. You're selling premium on the upside, and it gives
Mhm.
you a zone of maximum profitability actually higher than where the current stock price is. So even though it's a bearish leaning trade, my zone of my max profit actually would come into effect at the $55 level in AI 44 days out. That's where I'd make the most money, but I can't lose if it goes down. Now, if it goes above like 65 or something like that, then I start losing to the upside dollar for dollar. So for every $1 goes up, I lose 100.
Okay.
Above 62 and a half or something like that.
Okay.
Um, but yeah, I've traded AI in the form of Nvidia and the ticker AI. And I usually do it. I don't see how you can get long at these prices with Nvidia. So I've been trading that from the short side. Anytime it gets an up day, I might sell a call in there. And usually, um, even though I like the idea of being short, I'm not crazy. This thing has done nothing but go up, so I usually don't leave those trades on for more than a couple of days. I get a move in my direction and I'm closing it out. It's kind of a scalp in and out. Um, and then Tesla, I'm long Tesla. I don't know what else. Like I know you were you short Tesla for a while?
Um, yeah, I mean, I shorted Tesla on its big down move when it visited like $100. But then I got stupid long it. Then I came back short again on the stock. I think after that for a bit. I think I got yeah, when we got to 270, I became short on the stock again. Um, and
Tesla,
I've wanted to get short here recently and got blown out. Very recently, I wanted to get short again and
that's
got blown out.
that's
Um,
so I was short I was short of strangles in Tesla. So just like a neutral position, selling both sides of the market. And it's a good example of how I manage a trade because I was short strangles at I think around like 220 or something like that. And it continuously went against me, and I started buying stock to the point where I just bought 100 shares of stock for each call. And I was covered calls in there because like you can fight a stock to a certain point, but like Tesla has a pretty proven track record of ripping people's faces off. And I say to
yeah,
myself, okay, it's a stock like Tesla. Worst case scenario is I get a sign or it goes down. The premium is so jacked in there. I can sell calls against stock in Tesla until, you know,
yeah,
until kingdom come. And it's so juicy you can still collect a huge amount of premium. So I don't mind that trade.
make right money off of it. Yeah, yeah, it's a weird
I
one
don't
right
know.
now.
I mean, oil has been range bound. I know for a while there you were big into trading energy. I stopped trading most energy. I don't think I have hardly any energy positions on right now. Um, I'm short just naked premium and wheat through wheat futures. So I do have some kind of agricultural stuff going on, but I'm not really directional in there. It's just kind of a
I'm ex
uh,
I'm I want
premium
to
selling.
I want to come back in wheat eventually. I still think the fundamentals there have been solid. And I'm waiting for another winter to roll around. And I still think there's a lot of fundamentals, a lot of starvation that could be seen. It's just that some of these macro things that I have trades like that are so weird to me. And even with energy, is the time frames there are so long that sometimes there's 6 months where it's going to be a good trade, but it's still not there yet.
Yeah.
So
Well, I've
I've
been
just
saying that in weed, like weed, cannabis. I've been saying that in
yeah,
cannabis for the last 2 years, man. Talk about cannabis is the industry where I cannot make any money. Like unless
yeah.
you've been short cannabis for the last 5 years, you haven't made a penny. It's been the impossible trade. It's astonishing on how it has consistently gone down and down. And I know people that had a lot of money tied up, like in Tilray and stocks like that.
Oh yeah.
It's just all gone. It's like they're penny stocks now. They're all the whole industry is decimated.
Yeah, and CGC went down another 22% today even. Yeah. I think
What is
but I
that?
mean,
Negative 10 now?
yeah, what's that? Literally 45
It's
cents.
trading like oil. It's in the
Yeah.
negatives.
Yeah. So, I mean, yeah, they're gonna pay you to come pick up the weed soon, so get ready.
I guess. I don't know, man. Like, and my contrarian
Come get it
in
off their
me,
books. Yeah.
right? My contrarian in me just says like you gotta be long it here. But like, it's also said that for the last 2 years,
I
and
know.
it's done nothing. Like, it's just
But I mean,
continuously gets
we've
destroyed.
we have talked about this though, like the tobacco company theory of they just step in, they
Yeah,
take
yeah.
over. I think a lot of the market is thinking something of the sort. I don't know, maybe when you get the
I'll
federal
tell you what.
legalization, there'll be a turnaround, but
If there is a pot odds trade out there where there's the potential to make, and you look across where there's a potential to make serious money, and I just look at pure pot odds, how much do you stand to lose by getting long, like an ETF like MJ at this point, or an ETF that
oh,
gives you broad exposure and something like that, compared to how much do you stand to make? That's what I mean by like pot odds. I I even now I still like it. I just think to myself, okay, so if this thing continues to bleed out over the next year or two, I stand to lose, these stocks are they're pennies compared to what they used to be. So you
Yeah.
stand to lose what? A small amount in relation to the potential upside. So I like the pot odds in there. I am long some wheat or weed, but not anywhere near the size I was. That's just the trade that kept taking from me and taking from me. And I would sell calls against it, my stock, and just do covered calls in
Wow.
there. And it
Can't
didn't
make
matter.
anything off
It
of
just,
it. Yeah.
yeah, you couldn't make it. I would still lose money. Like my cost basis got reduced and reduced and reduced, but it couldn't just keep up with the speed at which weed was getting destroyed. But I'm
I
still
mean,
long it, glutton for
yeah.
punishment.
I mean, I'm pretty sure Canopy Growth is still the leader in the space, 45 cents. I mean, yeah, probably some good odds there if
It's
you
just,
just threw a little
it's,
bit at
it's
it.
just brutal.
Yeah, I don't
Just
know though.
brutal.
It is brutal. All right, well, so do you think? All right, so what do you think of the? I'm trying to get one of these traders that I know that keep telling me that Nvidia is going to go to 500 soon, and that Tesla is going to go to 320, and none of them want to actually get on a podcast and talk about it. So it makes me sussed out on the idea. But what do you think about that? You think we're in the AI bubble? Do you think we're about to hit some next level, that the FOMO has just begun,
No,
that people will rotate out of value and into growth, even though we're kind of seeing the exact opposite occur right now?
no, I don't think I personally don't think that we're in the beginning stages of an AI bubble. I think we're um well into what we saw when anybody mentioned crypto. A public company mentioned they were going to start accepting crypto, and we saw the bump in the stock price. If you look back, somebody sneezed and out came the word EV, and all of a sudden their stock was up 20% back in the day when we were in that bubble. So like the market sees these types of bubbles before, and we've already experienced. I mean, look at where Nvidia has come from. It just went through a 3-for-1 split when it was up to what, like $700 a share,
Oh yeah,
something like that. Yeah,
turns
and
back
now it's back to 430. I don't remember where. I don't even know where it is right now. Um,
423 right now.
but yeah,
Yeah,
so it's already up. What, like 200, almost 200%, 160% on the year or something like that. It's some
yeah.
ridiculous amount.
It gained
I
it
don't think it's
gained
to the beginning stages.
Nvidia gained the market cap of Intel in 20 minutes.
Yeah,
Yeah,
I
I
believe
mean
it.
it's like
Intel's a
literally
dog. I traded that
crazy.
for I traded Intel. I traded Intel for a long time, and I tell you what, I was happy to get out of there with like a break even. I that stock is awful. That stock is just a pig. It doesn't do anything but get your
Yeah,
hopes up. Like, but as far as again relative value, you look at these chip stocks and you look at the relative value of it. Intel looks enticing at this price point. When you look at the discount, so
yeah.
I'm long it right now. I will continue to lose money in it being long, but I'll stick to my I'll stick to my
We'll do it
guns.
together.
Yeah, so I am long it, but like I think we're past that point. Like if I had to choose whether I wanted to buy the 500 call or sell the 500 call over the next 60 days, I'd be selling it all day long
Yeah, I agree. No,
in Nvidia.
I think we've got a double top forming here, even in the S&P. So I'm straight up short, which you wouldn't like to do. Probably you'd rather be selling calls rather than buying puts. But
It's the same thing. Tomatoes, tomatoes. You stand to gain more. I have a higher chance of being correct.
yeah. Well, how often are you actually? All right, last question, because I should have asked this and I just realized I hadn't yet. How often? Because as a buyer, very rarely do I hold my contracts to the actual expiration. Almost never. And as far as
Oh yes,
exercising goes, almost never. But
same.
as a seller, most options expire worthless. You just said same though. So you actually are
Yeah,
also locking in profits early on in most
yeah. So
trades.
the way that the bell curve, the theta bell curve works in such a way that typically around the 3 weeks out It's 3 weeks till expiration. I'm managing the position one way or another. Whether it's if I still like the exposure and want to keep it on, then I'm buying the contract back and selling one out another 30 days out in time. So going back out of that 45-day mark or 60-day mark, or I'm closing it if I don't want the exposure anymore. Either way, I very rarely, unless I'm intentionally trying to get the stock or be short the stock, and want to be assigned, which is very rare for me because I like options more than stock. I very rarely take it past um, the 3 week mark. So most of my positions for this July that I would have had positions on, because I nearly always trade the monthlies. I don't trade the weeklies, just because there's more liquidity in the monthlies. There's more interest. So this last Friday was basically roll day for me. That was 3 weeks until expiration. Then I'm looking at positions and starting to manage them. I have a few like ones that are still hanging out there, but for the most part, I'm already out to August.
Oh wow. Okay. Wow.
Yeah,
All right. Well, I think we're gonna
just
call it.
because you get the most decay, you get like 60 to 70% of the decay and everything out of the options by that 3 week point.
Yeah. No, that makes sense to me. Yeah. I didn't really think about that, but there's no real point in to squeeze out the extra last bit when you've already made most of the returns you're going to have, disproportionate risk you're going to
Yeah,
have in the short term. Yeah, that makes sense to
very
me.
disproportionate.
Yeah. Well, thank you for coming on the pod, new trader.
Yeah, absolutely.
Hopefully,
Absolutely.
everyone
Thanks for having
now
me.
can understand how ironic your name is and how much we can all enjoy together. And people want to talk to you, of course, they could join in the Discord and stuff. And really appreciate your time, man.
Yeah,
I'll see you
I'm
around.
always happy to help any way I can. Take
Yeah.
care.
Take care.